this hour. The Nifty and Sensex gain over 0.5% each, but are off the day's highs. Automakers failed to press on the pedal in June, with sales continuing to fall last month. Reliance Home Finance rolls over repayment of 400 crore on non-convertible debentures held by Reliance Mutual Fund. The company pays the interest due. 3 Chinese lenders to Reliance Communications are in talks with foreign funds to sell their loans outside insolvency proceedings. We'll get to all of that. A quick check on how the markets are faring today. Darshan is here with some of those closer look at some of those stocks.
Yeah, we managed to hold on. The last 2 days have not been so good for the markets, but today managing to hold on. The Nifty up 70 points, the Bank Nifty up 250 points. Even the broader market seem to be doing well today, so there are no complaints, but it's managing to hold on. It's very range bound. No fireworks as far as the market is concerned. Surprisingly, despite poor set of numbers, the auto index is up 1.3%. Most of the auto stocks, even though disappointed, are trading with gains. Maruti's managed to move up. Bajaj Auto, Hero, TVS, all these companies have started to inch up in trade today. The other sector which has done well is real estate and pharmaceutical. So as a pack, these sectors are doing well in trade. Oil and metal, the ones which rallied over last week, have actually not moved up too much. Among the stocks, Escorts is up almost 3.5% given the strong auto sales numbers that has come out. Balkrishna Industries is up another 3%. Tata Motors, Dr. Reddy's are some of the counters which have actually managed to move up on the higher side. The ADAG Group and ONGC pretty much feature among the counters which have managed to lose out in today's trade.
Darshan, thank you for that. That's the structure of the markets. Finance Minister Nirmala Sitharaman will present her first budget this week. One of the biggest challenges she faces is on the fiscal front. Slowing growth has started raising calls for a stimulus, but does the government have the fiscal room for it? Pallavi Nahata brings us the pulls and pressures for the government finances this year.
Fiscal challenges abound as Finance Minister Nirmala Sitharaman presents her first budget this week. The BJP-led government had pegged fiscal deficit for the current financial year at 3.4% of the GDP in the interim budget presented in February. Retaining that target in the final budget on Friday has become even more challenging now, with lower than estimated revenue growth and rising expenditure commitments. In the interim budget, the government had projected a 14% increase in revenue receipts in FY20 over revised estimates for FY19. Within that, net tax revenue was estimated to increase by about 15% in the current financial year compared to estimated collections last year. This seems difficult to achieve considering revenue collections in the last financial year. 15.6 lakh crore rupees were collected as revenue in FY19. This was nearly 10% lower than revised estimates of 17.3 lakh crore rupees. The most significant component of revenue collections, that's tax revenue, stood at 13.17 lakh crore rupees, nearly 11% below revised estimates. This would mean that revenue collections would have to grow by about 26% this year, with net tax revenue rising by about 29%. To compensate for lower revenue collections, the government may seek to push up collections from non-tax revenues. On the other hand, the government may try to maintain expenditure across key schemes to avoid hurting the economy further. In the interim budget, the centre's total expenditure was projected to rise by 13.3% to 27.8 lakh crore rupees in FY20. This increase was already lower than the 14.7% increase in FY19. A large chunk of this increase was because of the PM Kisan scheme, expected to cost 75,000 crore rupees this year. After the elections, the government has expanded this scheme to cover all farmers, further adding 13,000 crore rupees in expenditure. With limited increase budgeted for other key schemes and items, the government may find it difficult to reduce expenditure. It is likely to keep off-budget spending high. Should the government target a higher fiscal deficit? Some economists say that the government may consider a wider fiscal deficit to support economic growth.
Reliance Home Finance has rolled over 400 crore worth of its debt it owes to Reliance Mutual Fund. The non-bank lender repays the interest due but has failed to pay back the principal amount. Neeraj has been tracking the story for us and explains to us where this is really headed.
Yeah, well, Harsha, the interesting bit was that when the statement came out, almost everybody knew where it's headed. But then the company came out and made some very interesting comments. So what happened? The 400 crores of NCDs, which were matured on Friday, they didn't honor them. They said that we've rolled it over, whereas it certainly looks like a default. They've said that they've made the interest payment due. So that was the thing that came in from them. But the instrument is extended by 4 months. The statement, very interestingly, is saying that in view of the continuing severe liquidity crisis in the sector, as now formally recognized by the Reserve Bank of India, the maturity of certain NCDs of 400 crores has been extended till October 31st, as if this is a very normal business practice. It certainly isn't. And the market is giving cognizance of that. Keep in mind, this is after how CARE had downgraded the papers, etc. Their own company, which is Reliance Capital, had said that they've reduced the outstanding commercial papers to 75 crores from 950 crores earlier. But as per the statement, this is a very normal business practice. Now, obviously, the market doesn't buy it. In Friday's session, maybe people had whiff of this. So it's a small stock. It was down about 8%, which is Reliance Home Finance was down about 8%. And it's down another 4-5% as we speak in today's session as well. Now, the company that has gotten, whether bondholders have gotten impacted, Reliance Nippon Asset Management, that doesn't get impacted too much, but that's queer. I mean, that's not queer simply because we've seen what's happened to HDFC, AMC as well. The earnings trajectory for these AMCs is so strong that such an incident may not impact the stock price. However, the NAVs for some of the schemes held by Reliance Mutual Fund have gotten impacted. I think about 2% impact on the NAVs of the schemes holding this, which is, the Reliance Hybrid Bond Fund, the Ultra Short Duration Fund, Credit Risk Fund, so on and so forth. So those names are out in the open any which ways. So the point is, the two ways to look at it, people will look at Reliance Nippon Asset Management and say that the stock hasn't gotten impacted, so not big news. But hey, this is big news because it'll probably drive the future course of funds into some of the credit risk funds of these companies. But two, the fact that Reliance Home Finance has made it sound as if this was pretty normal, whereas the fact remains, it is not.
Neeraj, thank you for that. Meanwhile, Chinese lenders to Reliance Communications are looking to sell off their exposures. They are in negotiations with foreign funds to strike a deal that's outside the NCLT process. Vishwanath Nair now joins us on the phone line with the latest on this one. Vishwanath.
Right, Hassan. So as you said, there are these Chinese lenders, three particular China Development Bank, Exim Bank of China, as well as the Industrial and Commercial Bank of China. All these three banks have a cumulative exposure of about 15,000 crores towards Reliance Communications. The point is that they have been trying to sell these exposures for about 6 months now. Conversations had originally started with US-based Wade Partners. Eventually, Bank of America Merrill Lynch, as well as SC Lowy. Both of these are large stress asset investors. All three of them have now joined the conversation. See, what we understand from our sources is that the negotiations around pricing is what is causing the delay, because initially the pricing was being determined at about 40 to 50 cents to the dollar. That's roughly 50-60% haircut for the lenders involved. But since Reliance went into insolvency, Reliance Communications went into insolvency in May this year, the price has dropped to about 15 to 20 cents to the dollar. So that's an important marker to say that the valuation of the loans have seriously dropped since the insolvency proceedings have started. And that is why the delays have caused. Now, the Chinese lenders and Reliance Communications have had a bit of a contentious relationship for the last 2 odd years now. Back in 2017, when the domestic lenders were considering invoking SR in the company, Chinese lenders have very categorically said that they will not participate in this restructuring. In fact, China Development Bank, which has about 9,800 crore worth of exposure to Reliance Communications, had decided to go to the NCLT with an insolvency proposal. That eventually got pulled back because the domestic lenders intervened and explained to the lenders, the Chinese guys, that they will get their money back eventually. But now that the conversation has gone back to the insolvency court and the company itself has gone into insolvency on its own accord, the lenders are now deciding that they want to probably exit the case rather than wait for the insolvency proceedings to go forth and see, difficult sort of recoveries from these accounts. Remember, they were also there, China Development Bank specifically was also there in Aircel Limited, where lenders had to take about a 99% haircut. So those experiences are also playing into the decision to exit the case before insolvency gets over.
Vishwanath, thank you for that. Vishwanath Nair reporting on that story. Automakers have failed to make up for any lost ground in June. Passenger vehicle and two-wheeler sales continued to slow down last month. Yash Upadhyay is here with the numbers that have come out so far. Yash.
Well, most of the automakers have reported lower than expected numbers for the month of June. I'll start first with Maruti Suzuki. Their total sales for the month of June were down close to 14% at 1,24,708 units versus street expectation of 1,30,000 units. This was mainly driven by a drop of almost 15% in their domestic sales, which came in at about 1,14,000 units, while exports saw a marginal increase of about 6% to 9,847 units. Bajaj Auto, the month was largely in line with what the street was expecting. 4,04,000 units is what they did versus the expectation of 4,05,000 units. This was mainly on account of the rise in their exports business. So the motorcycle exports particularly, that saw 11% growth on a year-on-year basis at about 1,51,000 units. The domestic business was largely flat, down only about 1%, but the commercial vehicle business, that saw a big 20% drop. On the other hand, Ashok Leyland is another player which reported a weak set of numbers. Total sales were down 19%, mainly on account of the big drop of 25% in the medium and heavy commercial vehicle space, which came in at only about 8,400 units versus a number in excess of 11,000 in the same month last year. LCV sales were relatively better, only down about 3% for the same month. On the other hand, Escorts came out with surprised the street with their numbers. The total sales were only down about 10% at 8,960 units versus an expectation of almost 8,200 units. So the numbers have come in higher than the street expectation, and this was again led by a big jump in their exports, although they contribute very less to the overall number. But the domestic business, that continues to remain under pressure, down 11.4% on a year-on-year basis to 8,648 units.
Yash, thank you. Retail auto sales also slumped in June. Registrations fell to its lowest level in 18 months, with passenger cars being the worst hit. Sajid has been going through the data on the Vahan portal. Sajid, so it clearly indicates the demand is not picking up.
That's right. On the retail level, while some of the companies are reporting lower numbers for June, those are factory gate numbers or wholesale numbers, but it translates into retail numbers only when they go for registrations. And so based on the data available for 31 states and union territories, we found that the sales are even more lower than what companies are reporting, which basically means that there is continue to be an inventory build-up happening on the ground level there. We saw a trend of that happening with some of the data last week, where the two-wheeler data was showing an inventory gain, while data for cars and CVs and tractors was showing inventory destocking, which was happening, and that's primarily because there was a correction in production by many of the companies. But here what we know that as per registration in the month of June, month on month the sales have fallen by 16%, while year on year it has fallen by 14%. For two-wheelers, it's 15% month on month and 14% YOY. Mopeds been impacted the most, with nearly 22% fall in month on month and 31% fall in YOY. Tractors being the other segment where we have seen a drastic fall happening on a YOY basis, with fall of more than 40% coming in, and on a month-on-month 12% fall. And in commercial vehicles, we have 20% YOY fall as compared to 15% month-on-month fall. So it's the retail demand, except for the week of Eid, we saw some kind of pickup happening, but even then it's fallen drastically, and it's at 18-month low.
Now looking good to the automobile industry. Sajid, thank you for that. The ever elusive earnings recovery, a slowdown in consumption and global trade tensions have shaken analysts' confidence this year. They've cut target prices for nearly half the stocks listed in India. Samit is standing by with some of the biggest target revisions this year.
So analysts have lowered target price for nearly half of the Indian stocks in the first 6 months of 2019, which is the worst cut seen in the last 3 years. Now, this is largely due to earnings miss, consumption slowdown that we have been witnessing, and because of a global trade war, which has led to volatility in commodity prices. So target price have been cut for nearly 132 of the 269 stocks that are tracked by at least 10 analysts. That is nearly 49% stocks that have seen a cut in its target price, which is the highest at least since 2016, where nearly 55.6% of the stocks tracked by at least 10 analysts had seen a cut in their target price. Now, the deepest cut we have witnessed in the sectors like auto, metals and telecom, while the biggest upgrades were seen in sectors like aviation, financial service and cement. Now, among the stocks which have seen the most cut in the target price, Simplex Infra stands out, nearly 55% cut in its target price in the first half of 2019, and this is because of the poor operational performance in the last 2 quarters, along with that higher tax rate and working capital. Poor working capital has led to this 55% cut in its target price. Now, Vodafone Idea's target price was lower by nearly 38%, but but this was largely because of the rights issue done by the company. Analysts had to adjust their target price, because of which it came down by nearly 38%. Sterlite Tech's target price was lower by nearly 36%, and that is because of lower margins that the company has been reporting in the last 2 quarters, and because of a drop in fiber prices that we had witnessed so far in 2019. Analysts had lowered its target price by nearly 36%. On the flip side, if you see, nearly 137 stocks had seen an upgrade in their target price, and on the top of the list we have there the 2 aviation stocks, that is Interglobe Aviation and SpiceJet, which have seen a revision of nearly 76% and close to 36-38% in their target price, and that was because of higher ticket prices, lower fuel costs. As you can see here, SpiceJet's target price was revised by nearly 47%, while that of Indigo by nearly 77%, and that is because of higher ticket prices, lower fuel cost, and a stable currency. Now, Manappuram Finance, now it saw an increase in its target price by nearly 37%, and that is because of operational efficiencies, that is low cost to income ratio, along with that lower NPAs and growth in new businesses led analysts increase their target price by nearly 37% for Manappuram Finance. Also, UPL saw a 36% increase in its target price, but that is largely because analysts had to factor in the higher income and synergy benefits that the company would get because of Arista acquisition. Now, in the first 6 months of 2019, there have been a change in the analyst preference also. Now, as you can see here, Axis Bank has seen 11 fresh buys in the first 6 months of 2019, and that is because the company reported an increase in its core profit. Along with that, expected moderation in credit cost, improvement in asset quality, favorable change in loan mix, and a solid management also led analysts change their stance on Axis Bank. Second on the list is CG Consumer, where nearly 10 analysts have rated a fresh buy for this stock, and that is because of a growth in the margins in the lighting segment. Along with that, management commentary of no impact of slowdown on the business, and market share, possible market share gains that the analysts are expecting. Nearly 10 fresh buys coming in for CG Consumer. On the flip side, Yes Bank has seen nearly 13 fresh sales in the first 6 months of 2019, and that is because of a poor earnings, credit ratings downgrade. Along with that, recovery in its no improvement in its asset quality has led to this 13 new fresh sales. Then other stocks that belong to this category is Bajaj Auto, Eicher Motor, Ashok Leyland, and Maruti Suzuki, which have seen fresh sales in the range of around 8 to 11, and that is because of the slowdown that we have been seeing in auto sales so far in the first 6 months of 2019.
Soumya, thank you for that. The United States and China have agreed on a temporary truce on trade, one that Donald Trump claims is helping the US win the trade war with China. There's been no comments from Xi Jinping's side, though. Yvonne Mann from Bloomberg News reports.
Well, they've hit the pause button for now, US and China. A lot of key questions of whether this trade truce can last, but it seems like what we got out of Osaka was a little bit more than what we got out of the G20 in Buenos Aires back in December here. Yes, they agreed that they were not going to add additional tariffs. Those current tariffs, though, still in place. They have pledged to restart talks between the two sides, and perhaps a bit of a breakthrough when it came to Huawei as well, with the president suggesting that U.S. companies are now allowed to do business with the Chinese company. Reporters asked pointedly, does this mean that Huawei can be taken out of this export blacklist? Here's what he had to say.
U.S. companies can sell their equipment to Huawei. We're talking about equipment where there's no great national emergency problem with it, but the U.S. companies can sell their equipment. So we have a lot of the great companies in Silicon Valley and based in different parts of the country that make extremely complex equipment. We're letting them sell to Huawei.
So what experts have been saying is, did President Trump give away this technology race in favor or over some handful of soybeans? The Chinese did agree that they would be buying more of U.S. agricultural products, but when it came to the core issues that led talks to break down back in April, it doesn't seem like we got any concrete details on that, whether it is concessions on intellectual property, tech transfers. We really didn't hit those quite well. So this is leading a lot of market analysts to say that this trade truce, this relief rally, could be pretty short-lived.
Yvonne Mann reporting from Seoul. Oil prices, meanwhile, surge after Russia and Saudi Arabia have agreed to extend production cuts for 6 to 9 months. Iraq, however, maintains that this is not a done deal. ANZ's Daniel Haynes tells Bloomberg Television that he expects from OPEC and its partners at this juncture.
From their perspective, certainly Russia's taken a much bigger influence in talks lately, and I suspect, members like Iraq just want to bring back, I suppose, some of their authority in this agreement. So, clearly, I think leading up to this point, we're quite, adhesive to that type of agreement. But I think the fact that it was already essentially agreed to by Russia and Saudi on the sidelines, they want to have a little bit more say in that. So I think it's just a bit of posturing, but I suspect it is a fait accompli. We will see a broad agreement at OPEC. It'll only be, I suppose, the timing and the extent to that extension, whether it's going to be just to the end of the year or into 2020.
Yeah, more broadly though, it doesn't speak to a great deal of optimism around the demand picture, does it?
No, true, and that's always been an issue. But I think over the weekend we saw, obviously, US and China agree to restart talks around the trade conflict, and that, I suppose, presents some sort of upside to the weakening economic growth we've seen. So the combination of the two, I think, should be supportive for the oil market.
What does it say about the supply risks out there if we continue to see this extension of curbs?
Yeah, and I think that's been the big issue that OPEC has to deal with. Clearly, demand for their oil is actually rising as we see declines from Venezuela and Iran in particular. So they're having to negate, or I suppose battle that issue with obviously the weakening sort of economic backdrop, and that's been a balancing act, a fine balancing act that they've had to sort of walk along for a little while now, and clearly will have to continue to do so in the near term. So I think for them it's going to be certainly something that they closely follow, and maybe in the background you may see Saudi in particular just gently increase their output to meet customer requirements. But certainly the messaging, I think, will be that they'll keep constraints on output while there's this debate about how growth in demand is going to go over the next 6 months or so.
Dan, let me ask you a little bit about the dynamics between all of these players, because we're now hearing that OPEC Plus could be close to finalizing a charter for a long-term alliance. Is this a significant shift when it comes to the world oil order, or is this just a continuation of what has already been happening?
I suppose it is a little bit of formalisation of that agreement. Certainly, OPEC's market share has been declining, and certainly bringing in other members, in a sense, gives that voice, I suppose, a bigger say in the direction of oil prices in the near term. So I do think it's partly just protecting their voice and certainly formalising the agreement that they've essentially come to now over the past 12 months or so.
Out of time on the show. Thank you so much for joining us. Stay tuned to Bloomberg Quint.